Have you ever stopped to think about how the real giants in tech are tackling this AI wave? I mean, it's not just about keeping up, is it?
No, not at all. It feels like they're actively trying to lead it, changing how whole industries work.
Yeah.
It's way beyond just a buzzword now.
Exactly. It's fundamental. So, welcome everyone to the deep dive. We're the show that tries to cut through all that noise and get you informed quickly.
And today, we're diving deep, really deep, into SAP, the global leader in enterprise software, and now very much business AI.
That's right. And we're drawing directly from their latest half-year report for 2025. It's packed with info, financials, strategy, even sustainability stuff, a real treasure trove.
Yeah, it really is. So our mission, I guess, is to pull out the most important bits for you, give you that shortcut to understanding what a massive player like SAP is doing, maybe uncover a few surprises.
And figure out what it all means for, well, for the rest of the business world, and maybe even for you listening.
Okay, let's get into it.
Right. So, SAP's big strategy. The report hammers home these two phrases, AI first and suite first. What does that actually mean in practice? It sounds a bit like marketing speak, but it feels important.
It does, but I think it's more than that. Fundamentally, they want to be the #1 company for enterprise applications and business AI. It's about synergy.
Synergy. How so?
Well, think about it. Their core apps, finance, HR, supply chain, whatever the huge amounts of data flowing through them, and then AI. They're not separate things anymore. They're being woven together.
Oh.
And suite first means making sure all those different parts talk to each other seamlessly with AI embedded throughout. So your whole business operation acts like one smart integrated system, not just siloed departments.
Gotcha. One integrated brain, basically. And speaking of smarts, they announced some pretty interesting innovations. Let's start with the SAP Business Data Cloud, the BDC. What's the big deal there?
Right, the BDC. It's a new SaaS solution, fully managed.
Mm-hmm.
What makes it stand out, I think, is how it handles data. It brings together all your data, SAP stuff, non-SAP stuff.
Okay.
But crucially, it aims to keep the meaning, the semantic context, intact. You know how revenue in one system might mean something slightly different in another?
Yeah, that's a classic headache.
Exactly. BDC tries to act like a universal translator for that data context,
Yeah.
which is absolutely vital if you want to feed reliable information into AI models. And tools like SAP Databricks are built in, giving data pros the tools they need right there.
So it's about making data AI ready right from the start. Understandable. And that leads us nicely to Joule, their AI agents. These sound like more than just chatbots.
Oh, absolutely. These are designed for multi-step autonomous workflows. It's a significant step up. And look at the speed they launched 14 agents in the first half of 2025 alone.
Wow, 14 already.
Yeah, and they're aiming for 40 by the end of the year. That's really aggressive.
What makes them tick? How do they work?
A key piece is something called the SAP Knowledge Graph. It acts as a semantic bridge, as they put it. It helps Joule figure out the most relevant data for a task. So the AI isn't just processing data, it's understanding the business context, reasoning, planning, acting more autonomously.
That context piece sounds critical. And they're already putting Joule to work in very practical ways, aren't they? Like the Joule Studio.
Yes, launched in June. It lets users actually build their own AI agents, securely, scalably. It's quite empowering, putting AI development closer to the business users themselves.
And the time savings seem pretty concrete, too, for consultants you mentioned?
Yeah, potentially saving up to 90 minutes a day on cloud projects. Think about understanding complex ABAP code. That's SAP's proprietary language. Joule can help explain it, speeding things up immensely. That used to require deep specialist knowledge.
That's huge, democratizing that knowledge almost. And for developers.
They're seeing productivity boost up to 20% with these AI tools. Compound that across a large development team, it adds up fast.
And it's not just internal efficiency, right? There's a sales platform, too.
Right, the digital sales engagement platform, powered by Joule, aims for up to 50% productivity gains in some sales roles. Plus, this integration with WalkMe.
Oh, yes, the omnipresent action bar.
Exactly. It follows you around across SAP and even non-SAP systems, connecting data, smoothing out workflows. The idea is to make AI help feel, well, just there, wherever you're working.
It's weaving AI into the fabric of work, and this internal focus seems to be matched by external moves, too. Lots of partnerships announced.
Yeah, that was noticeable in the H1 report. Accenture for connected intelligence, Perplexity for generative AI and search, combining unstructured and structured data.
Palantir 2 for cloud migration help, and Alibaba Group for cloud transformation acceleration. It really paints a picture of SAP building out its ecosystem, embedding itself deeper.
Definitely. They're not trying to do it all alone. Okay, so that's the strategy and the tech push. But what about the world SAP is operating in? The economy.
Right, let's zoom out. The report mentions, based on ECB data, a moderate slowdown globally in the first half of 2025. Trade issues, tariffs, costs. The usual suspects creating some drag.
We saw that play out differently in different regions, didn't we? The euro area held up okay at first, then dipped a bit. U.S. tariffs definitely had an impact, especially on places like China.
It's a messy global picture. So how does the IT market react in that kind of environment?
That's where the IDC insights come in. They paint a picture of rapid evolution in enterprise IT. AI, automation, cloud native, these are the big drivers. Companies are actively turning to AI for productivity and efficiency gains.
And crucially,
IDC says the #1 reason companies are modernizing their core applications right now is specifically to make them AI-enabled. It's not an afterthought. It's the primary driver for change.
so even if the overall economy is a bit sluggish, AI investment is actually a priority. It's seen as the way through the uncertainty, perhaps.
It seems that way. And SAP is positioning itself perfectly for that, aligning its whole strategy around enabling that resilience and transformation for its customers.
And analysts seem to be noticing. The report mentions acknowledgement of their disciplined execution and rapid AI enablement.
Yeah, that phrase stood out. It suggests their strategy is translating into tangible action, connecting data, intelligence outcomes. It's not just talk.
Okay, strategy makes sense. Execution seems disciplined. Let's talk money. How did this all translate to the bottom line in the first half of 2025?
The numbers are pretty strong. Total revenue, 18.04 billion. That's up 10% year on year, or 12% if you adjust for currency fluctuations.
Solid growth. But what about that predictability metric?
Yes, that's a big one. The share of more predictable revenue, think subscriptions, support climbed 2 points to 86%.
86%, that's massive, isn't it? What does that signal?
It signals stability. Huge stability. It means they're not overly reliant on big one-off license deals anymore. Most of their income is recurring. That gives them a solid foundation to invest from.
And what's driving that stability? Cloud, I assume.
Absolutely. Cloud is definitely king here. Cloud revenue jumped 25% to over 10.1 billion. That's 27% growth at constant currencies, mostly driven by their cloud ERP suite adoption.
And the backlog, the future pipeline.
Also very healthy. Current cloud backlog hit 18.05 billion, up 22% or 28% at constant currencies. But here's a fascinating detail.
Go on.
About half of their new cloud orders in the first half included SAP Business AI.
50%. Wow. So customers aren't just buying cloud, they're specifically buying the AI-infused cloud.
Exactly. It's a massive vote of confidence in that AI-first strategy directly from the market. And you see the flip side, too. Traditional software license revenue was down 13%. Support revenue down 4%.
Which is exactly the shift they want, right? Moving customers to the cloud model.
Precisely. It's the planned transformation playing out.
Okay. Revenue strong, cloud's booming. What about profits? The IFRS operating profit number looked astronomical.
It did. Up over 100% to nearly 4.8 billion, compared to just 434 million the year before. It's a huge leap.
What caused such a massive jump?
The main reason was much lower restructuring costs this year compared to H1 2024. Remember that big transformation program?
Oh, right. So for a cleaner operational view, we should look at the non-IFRS number.
Exactly. And even the non-IFRS operating profit, which smooths out those one-offs, was up a very healthy 45% to just over 5 billion. And importantly, the cloud gross margin improved too.
How much did that improve?
The non-IFRS cloud gross margin went up 1.9 percentage points to 75.2%. So the cloud business isn't just growing, it's getting more profitable.
So growing and becoming more efficient, that's the sweet spot. And profit after tax, earnings per share, they followed that IFRS profit trend.
They did, both up over 100%.
Right.
IFRS profit after tax was 3.5 billion and basic EPS hit 2.98. Clear signs of successful execution.
And this all ties back to that cost management and restructuring you mentioned.
Definitely. Overall, IFRS operating expenses dropped 17%, largely because that 2024 transformation program wrapped up at the start of 2025.
So those huge restructuring charges from last year, what were they? Nearly 2.9 billion. basically vanished.
Almost entirely,
Yeah.
down to just 18 million in H1 2025. And remember, that program affected about 10,000 roles, but mostly through voluntary leave and reskilling efforts, not just layoffs. It was a strategic reset.
Interesting detail about the share-based parents being lower too. Partly market conditions, partly a new hedging strategy.
Yeah, a bit of both. Lower share price increases compared to the prior year played a role, but they also implemented a new hedging approach for cash-settled compensation. Just another sign of, sophisticated financial management.
All this efficiency must show up in cash flow then.
It certainly does.
Yeah.
Operating cash flow jumped 45% to 6.36 billion, driven by, well, higher profits, better working capital, lower share payments, lower taxes. Basically good performance across the board.
And free cash flow. That's the really crucial one for flexibility.
Up an impressive 51% to 5.94 billion. The free cash flow margin grew 9 points to 33%. That's very strong. They did tweak the calculation slightly for 2025, by the way, including proceeds from asset sales and reclassifying interest to give what they see as a more holistic picture.
Good to know. And finally, on the financial side, what about returning cash to shareholders?
It's been active. The share buyback program, up to $5 billion ending this year, had already repurchased $4.6 billion worth by June 30th. Shows confidence. Plus, they paid out a dividend of $2.35 per share for 2024.
And their overall liquidity.
Net liquidity stood at a healthy $2.3 billion. So yeah, the balance sheet looks very solid.
Okay, so strong financials underpin the strategy, but there were organizational changes too, and a focus on sustainability.
Right. They simplified their structure, moving to just 2 operating segments from H1 2025. Applications, Technology and Support, ATS, that's the main product engine, and Core Services, which is consulting and premium support.
Did that restructuring help focus things?
It seems so. ATS segment profit was up 30%. Core Services profit up 40%, benefiting a lot from those cost savings from the restructuring program. So, better efficiency in both main areas.
And leadership stability seems important during all this change.
Yeah, they extended the contracts for CEO Christian Klein and CFO Dominic Assam. Sends a signal of continuity.
Now, sustainability, that 90% reduction target by 2030 sounds ambitious, especially with AI's energy demands.
It is ambitious.
Yeah.
And they acknowledge that challenge. They hit a 10% reduction in emissions in H1 compared to last year, putting them at 3.2 million tons of CO2e. But they are actively monitoring if the target needs adjustment because of AI's energy footprint. That's a really interesting and honest point they make.
But dilemma facing the whole tech sector, really.
Absolutely. And they're also investing in carbon removal tech now, aiming to neutralize some of those unavoidable residual emissions. It's a multi-pronged approach.
This focus on the future seems to extend to their people, too, with this people agenda.
Yes, it's framed as a holistic system. Growth culture, skills focus, using tech internally. One key change was replacing the Women in Executive Roles KPI with a broader Business Health Culture Index, BHCI.
BHCI, what does that measure?
It aims for a more complete view of the employee experience beyond just one metric. It's currently at 81%, which is within their target range. Employee engagement overall is at 78%. So, positive signs there.
And they're really leaning into skills, aren't they? Preparing their own workforce for this AI shift.
Definitely. Streamlining skills definitions, updating job roles, piloting an AI-driven HCM platform. They plan to roll that out by 2026. Including AI-powered learning, tailored to skills gaps. They're practicing what they preach about transformation.
And the overall headcount is up slightly.
Yeah, just under 109,000 full-time equivalents at the end of June, up from about 105,300 a year prior. So investing in people alongside the tech.
Okay, so strong performance, clear strategy, focus on people and planet. What does SAP see for the rest of 2025 and beyond? Does the outlook hold?
Remarkably, yes. Despite all the global uncertainty, their full-year 2025 non-IFRS outlook remains unchanged. That speaks volumes about their confidence.
What are the key targets again?
Cloud revenue expected between 21.6 and 21.9 billion. That's 26-28% constant currency growth. Total cloud and software revenue 33.1 to 33.6 billion. Operating profit 10.3 to 10.6 billion, and around 8 billion in free cash flow. Still very ambitious targets.
And looking further out.
They expect revenue growth to actually accelerate through 2027, mainly from cloud. And crucially, they expect operating expenses to grow slower than revenue, partly thanks to using their own AI internally for efficiency gains.
Ah, the internal AI payoff. That's key.
It is, though they do expect traditional software support revenue to keep declining, naturally. And capital spending will likely increase a bit, maybe hitting $1 billion in 2026, as they invest more in cloud infrastructure capacity. Makes sense with the growth.
Of course, risks remain. Geopolitics, trade tensions, these can still slow things down.
For sure. They mention those potentially elongating sales cycles in some areas. Agility is still the name of the game. And like any big company, they have ongoing legal things. IP lawsuits with Teradata, Celonis, tax matters.
But nothing they currently see as fundamentally threatening the business.
That's their assessment, yes. They believe none of it will have a material adverse effect right now.
So, wrapping this up, the big picture seems to be SAP executing strongly on its AI and cloud strategy, translating that into impressive financial results, even with economic headwinds. They're really leaning into this transformation.
Absolutely. That AI first, suite first mantra isn't just words. It's driving everything. Product development partnerships, internal skills, even how they measure employee well-being. It suggests adaptability and intelligence are just table stakes now for enterprise success.
It really makes you think. Given SAP's huge push into AI, both for customers and internally, what does this deep dive suggest about the skills you might lead in the future, in this kind of rapidly automating business world?
Yeah, how will other companies inevitably follow suit? And what doors does that open or close for your own career path? Something to ponder.